Since the Federal Reserve cut their short-term rates 0.5% on September 18th, we've seen 30-year fixed mortgage rates rise meaningfully. Now you're going to be wondering, how can this be? So the Fed is reducing the Fed funds rate, which is not mortgage rates or even a long-term rate. The Fed funds rate is a very short-term rate, literally a rate that's only good overnight. Now, banks use this as the rate that they lend money to one another, but it's the building block for all interest rates. So when the Fed changes the Fed funds rate, it almost immediately impacts things like money market accounts, credit cards, car loans, home equity line of credit, etc., etc. But long-term rates, like mortgage rates, they're impacted more indirectly. So an example of this happens as the Fed cuts rates and investors' return on money market funds decrease. If it's anticipated that the Fed will continue to lower rates, which in turn will continue to reduce the return on money markets, investors, they may want to preserve their returns by selling their money markets and buying longer duration bonds like 10-year treasuries. As more 10-year treasuries are purchased, their price tends to improve, which in turn lowers the yield. Mortgage rates typically follow the direction of 10-year treasuries. So recently, in anticipation of a well-telegraphed rate cut, it was literally talked about up front, the 10-year treasury and mortgage rates had declined significantly. Therefore, the financial markets had already priced in the cut by buying treasuries in advance of the Federal Reserve announcement. And then after the Fed's cut, a surprisingly strong jobs report and a more stubborn inflation data were released. And this has created that spike higher in long-term mortgage rates. Now, it's highly likely that the Federal Reserve will continue to reduce the Fed funds rate and will eventually see that filter into long-term mortgage rates.